life insurance policy, and it was a modified endowment contract. Waka Flocka cannot put $2 to $3 million inside a life insurance contract and enjoy tax benefits if he wants income tax withdrawals down the road. So if he just shoves $2 to $3 million into a life insurance policy from day one, then it will automatically turn into a modified endowment contract, and thus he cannot withdraw money since he's under 59 and a half years old without paying any penalties or income taxes. Because under modified endowment contract laws, if you take money, permanent life insurance, where it talks about stuff and cash inside it, and what are some of those characteristics of permanent life insurance contracts? There's whole life policies, there's universal life policies, there's variable life policies, and then there's index universal life policies. I dare to think that he may not be talking about the variable life policy, because this is one of the four that is not guaranteed. It's tied directly to the ups and downs of the stock market, and the least appropriate life insurance policy for this strategy. So first, in a 5-year period, okay? He's put a $600,000 over a 5-year period in this example. Now, in a guaranteed column, the insurance company is going to say, okay, this is the most amount of money we can charge you for cost of insurance. And this is what's going to happen when we do not credit you the highest amount of interest. The minimum we can credit you on the policy, contractually speaking, inside these contracts, this is what your money's going to look like. The non-guarantee says, well, this is what we're going to charge you based on current costs of insurance, not maximum cost of insurance, that is in guaranteed column, but also we'll talk about some tax guidelines here of what you can shove into a life insurance policy by maximum funding it. You want to have the minimum life insurance afforded to you by the IRS tax code that you can shove all this cash in and still qualify under the definition of it actually still being a life insurance contract by minimum death benefit and maximum funds inside the policy, by stuffing a lot of cash inside this particular life insurance contract. So what motivated this video is that we publish this money for income or investment purposes, to invest in other things or to live on. You don't want that. But if you want to make sure you have tax advantage guidelines down the road, you have the opportunity to do that. So this is a ledger, okay? This is a sample of a ledger from a properly trained life insurance agent that understands these strategies, but this is, generally speaking, a ledger you would see inside a life insurance policy. Because traditionally, what a lot of people think, 401k, okay, I'm saving for my retirement. So let me break this outside a modified endowment contract, which is a life insurance policy that now lost its tax advantages. You have to pay a 10% penalty, just like an IRA or a 401k, and income taxes on the gains that you have inside the life insurance policy if now your life insurance policy is deemed as a modified endowment contract. So people didn't like that. So next thing you know, DEFRA was passed in 1984. Deficit Reduction Act in 1984. And then in 1988, TAMRA, Tax and Miscellaneous Revenue Act. Maximum funding permanent life insurance contracts. And there's a little bit of history behind this. So what happened in 1982, a tax code was passed called TEFRA, Tax and Fiscal Reconciliation Act of 1982, which basically created guidelines for life insurance to qualify as a certain definition of life insurance if you have lots of cash inside these life insurance contracts. So then they defined what a modified endowment contract meant. Which column? Second one is most likely your non-guaranteed column. The third column is your death benefit column, okay? Different insurance companies illustrate it differently, but this is generally what they would show inside an illustration. So in this example, we got $3 million coming to a policy where $600,000 a year, $600,000 a year, $600,000 a year, $600,000 a year is in this example, okay? And then for the rest of the policy years, the rest of the life of the policy, I'm presuming Waka Flocka would put 0 into the policy. In this example, he's putting away $3 million. Fancy that may all sound. If you don't have the finances, the cash flow to fill it and fund it, the best plans lose. So you have to find ways to make sure you solidify your cash flow first. I served 8 years in the United States Marine Corps, and I didn't learn any of this stuff until maybe my last year in. Why? Because I went through some financial challenges. I got married, divorced, filed bankruptcy, found myself in a very bad position. I found myself as a single father in custody of my kids. So you have to address this thing called risk. And usually in this context, talking about here, right? He says, open up insurance, put $2 to $3 million and borrow from that.
Man, please. Yeah. Please. I'm going to open up insurance, put $2-3 million in my insurance and borrow from that and put it back in.
Well, I'll break it down even further, because the other side of the spectrum is actually what he's talking about, where you maximum fund a life insurance contract with as much cash as you can contribute to it, okay? Based on the availability and the insurability of your life. And what moves? What's the next move? As soon as I get my budget together, as soon as I solidify my income, as soon as I solidify this, that, blah, blah, blah. What's my plan? What's my next moves? Am I happy here? If I'm not happy, I need to have an exit strategy. If I'm working on plan A and plan B is not where I want to be, that then becomes then plan B. You got to find now a plan A you're transitioning into. So plan your next move. Number 2, you need persistency, commitment, urgency. You need to surround yourself with wise counselors and advisors, which means that any money that's inside a life insurance policy can still be transitioned to the beneficiary upon the demise of the owner without paying a dime in tax under IRS code 101A. Okay? So if you die with a life insurance policy, any money that you have with that life insurance company will transfer to your beneficiaries without paying a dime in tax. So it included not only the death benefit, but also the cash value. Now, let's say you had $100,000 inside a life, okay? Term insurance policy. Let me explain. Let me go further. So sometimes people go, there's 2 ends of the spectrum here, okay? There's 2 ends of the spectrum. People can say, you know what? I'm going to minimum fund my financial strategy, my insurance strategy, and this is what usually term insurance is all about. So the term insurance says, let me get the least amount of cost for the biggest amount of death benefit. That's my style of life insurance. But the challenge with this term is that you have to have a demise of yourself in that term. You put $50 a month into the 2, we're gonna, in column 2, it says, this is gonna be the current charge we have with cost of life insurance based on your age and your gender and your health rating, whether you're standard, a non-tobacco rating or preferred elite rating means you're the healthiest, so therefore your cost of insurance is the lowest. Down right quick. These are different retirement plans that all come from the Internal Revenue Code. See, these retirement plans, when people say, I've got a job, I got benefits and a 401k, well, it's IRS 401 Chapter K. You're usually working for a for-profit corporation. If you're working for a non-profit corporation, a city hospital, or a school, you most likely will have a 403B. If you work for the city, a municipality, you usually will have a deferred compensation or what they call a for a 30-year insurance policy for a 30-year period. So $50 a month policy every month for 30 years, for a 30-year period. In exchange, from day one, the moment you put $50 into this policy, from day one, if something, Lord forbid, were to happen to you, a $500,000 death benefit in this example would be paid to your beneficiaries. And that's where most people think that life insurance is all about. What Waka Flocka in real life, there's whole life, and then there's, in 1980 was created universal life, and then in 1996 was created index universal life. So there's 3 different iterations of life insurance that fits the potential strategy when somebody says, I want to put money inside a strategy to accumulate wealth, not pay a dime in tax as it's growing, and then withdraw that wealth without paying a dime in tax legally and ethically according to the IRS tax code. So what Waka Flocka is talking about is maximum funding life insurance to stock market and economic losses. So when you're looking at IRS code 7702, what you're combining is, how do I get access to my money in a short period of time before I'm 59 and a half years old? How do I make sure my money is safe? How do I make sure that my money has a decent rate of return? And number 4, my money has significant tax advantages. We call this the laser test, LSRT. So anybody asks you, hey man, you should put your money away here, put your money away there, put your money, does it pass my laser test? And by the way, there's a video right here. We're not a financial advisor. I'm simply a licensed life insurance agent building national agencies across the United States. And I want to break down what Waka Flocka was sharing here, some areas that a lot of people got excited about because they didn't realize that life insurance has these tax strategies and tax advantages and opportunities that a lot of people thought that was just for either the rich or for people that was going to be buried in their funeral one day. So let me just share with you a little bit of baseline, a little bit of foundation, call that the 4 homes of money. Okay, so watch this video here. If anybody ever tells you to put your money somewhere, you now have a system by watching this video to help you make educated and aware choices of what to do with your money. Again, I'm not a financial advisor. I'm just educating you on some of the questions you need to be asking yourself to process this so you have a formula to make better educated decisions. Okay, so back to the ledger. As an example, you're gonna have one column here and a second column here and a third column here. One column is gonna say guaranteed video with my reaction to what Waka Flocka said about financial literacy and what he said also about life insurance. He said, open up insurance, put $2 to $3 million in it, and borrow from that. What Waka Flocka said with $2 to $3 million, you can break this down to $200,000 to $300,000 from your gains in real estate to $20,000 to $30,000 that you may get from a bonus or just saving your money over a period of time, or $10,000 to $12,000, $13,000, $15,000 that you say, you know what, I got some money here I want to save, and in purpose of this video, I'm just going to X this out of this conversation and assume that he's not using variable life insurance policies. Again, one of the most risky policies out there in the marketplace. And oftentimes people who have not gotten advanced training on life insurance, who still have trained from the 60s, 70s, and 80s, think that permanent life insurance policy is all but one policy, which is called whole life. Watch, you'll see even in the comment section below, people talking about whole life, whole life, whole life, whole life, whole life, thinking that that's the only style of policy with inside time and experience, which you do not have yet. So here's what you should do, here's what most do, and what most people think about life insurance. Oh, it's only for older people. Oh, it's only later in life. Oh, it's too expensive, I can't afford it. Oh, it's unnecessary when I'm single. Oh, I got insurance already, I got it at my job. Hey, listen, this is not what we're talking about. This is not your granddaddy's policy. This is not a group policy. This is not your job's policy. This is an individual life insurance policy and strategy that we're discussing here. Oftentimes people think, okay, let me just get the typical term insurance policy, and why a lot of people get their money wrong. This is not something that you just say, okay, I'm gonna watch one video, I'm done with this. You need to reach out and say, listen, I need to find some wise counselors and advisors who have been there, done that, who've been through some good times, been through some bad times, and still living to talk about it. One of the strongest structures in the history of humankind is the triangle, the pyramids of Egypt. And when you build your foundation of your home, you want to build it in a conversation about risk. That's when I stumbled across how to mitigate and minimize risk, which is through life insurance. The next thing is you should build upon that, and is there savings for emergencies and opportunities. Next thing, you have to have a debt management strategy for good debt and bad debt. And then you start talking about your investments. And then you start talking about a 401k. And then you start talking about stocks, bonds, mutual funds, real estate, crypto, collectibles, etc., etc., gold and silver. The challenge with a lot of people, though, they got their money like this. It's all turned upside down instead of building a solid financial foundation. So your life insurance agent should be familiar with these strategies. Obviously, Waka Flocka is an insurance agent that properly educated him, made him aware, say, hey man, compared to anything that you could put your money into to grow and compound and to protect yourself from losses in the economy, losses in the stock. By the way, whole life, if the stock market crashes, if interest rates go high as they're doing right now, and the economy has a massive crash, guess what a whole life policy will still promise to pay a policyholder? The dividends it promised to pay. 57 retirement plan. You work for the federal government, so you should call it a TSP, a thrift savings plan, or you're working for the unions, you have a pension. Okay? So all come from where? The Internal Revenue Code. So these companies and or the individuals, you can put your money here and have significant tax advantages. But insurance falls not under 401k, 403b, 457, TSP pension. IRS falls under, again, IRS code 7702. IRS code 7702 of the Internal Revenue Code. The interest rate that the Universal Life will pay. Same thing here with the Index Universal Life policy. The tracking of the S&P 500 or the Hang Seng Index or the Russell 2000 Index, whatever indices that an Index Universal Life policy will track, it will make sure it records the gains, but none of the losses. That's why a lot of people love these strategies love these particular policies for this strategy, because these three policies, not the variable life, will remove you from exposure. You're not surrounded yourself with people that are just not YouTube gurus or YouTube channels like myself. Like, if you're seeing this video and you don't know who I am, please don't rest upon this video to help you make your decision with your finances, or in this case, your insurance. Please take this video, read these books, watch many other videos to fill up your mind, to help you create an educated and well-informed decision. What most do, however, is they fill their life with impatience, with desperation, get rich quick. Top or from the bottom up, it's from the top up, where the investments are the first thing they talk about, and then real estate, and then debt, then savings, and let's figure out this thing called cash flow. The sad thing about where a lot of people think about money is just finding ways to get rich quick. The best strategy is how to get rich methodically over time, so therefore it lasts. So here's what you should do. A couple things that you should consider. Number one, you should have a plan for your next move. Opportunities, they're lazy, they don't really want to work it, so therefore they wing it, and they only teach themselves. They're self-taught. Listen, I get self-taught, but if you want to learn a very important topic, such as life insurance strategies, such as planning your financial future, is a very important thing that you surround yourself with a lot of people that have been there, done that, versus you just trying to figure out as you go along. Because a lot of these folks who have been there, done that, the perspective they can give you is somebody's over 50 years old, over 4 installments, 3 years in one day or 4 years in one day, installments into a life insurance contract. Now, with that being said, if that's what he was doing, if I'm not his financial advisor, his business manager, or his insurance agent, I'm just presuming what he said. I'm just trying to break down what we've done for clients that fit this type of profile, that you filter this money in. So let's say you have, in this example, let's say you have $3 million. Now you're filtering in $600,000 over possibly have a gain from my future. How do I do that with a life insurance contract? And I'll share with you. There's many different ways to do it. What Waka Flocka is talking about is permanent life insurance, okay? Over here, we were talking about term insurance, where it's the least amount of cost for the most amount of death benefit. A different mindset comes to you looking at life insurance from a financial strategy to accumulate wealth and to be able to, was created in 1988, which said, okay, if you want money inside these insurance contracts, you have to pay what they call, you have to follow a corridor called the 7-pay or the MEC guidelines to have money inside life insurance in a tax advantage way. Meaning that if you're under 50 years old, which Waka Flocka is, he can basically shove $2 to $3 million inside a policy in a 3 installment period time frame, or if it's a 3-year period or a 4-year period, you got 600 grand basically go inside a policy. So I kind of put together what you would see on an insurance ledger. Okay, so if you're working with an insurance agent and they understand these strategies, then they will know how to create an illustration for you that fits the guidelines of 1984, 82, 84, and 88. TEFRA, DEFRA, and TAMRA, and avoid a modified endowment contract scenario where you are taxed later on if you want to withdraw from it without paying a dime in tax. By the way, he didn't even mention that in this video. He didn't talk about not paying a dime in tax. So you can accumulate this money inside properly structured, maximum funded life insurance contracts and withdraw it or loan from it without paying a dime in tax. And what permanent life insurance structures, basically what he's talking about is permanent life. And that's a style of life insurance. There's one style, which is term insurance, which I explained before. And the other style is an area where it's strong no matter what happens, weather, changes in environment, this structure will stand strong, like your house, like your financial house. So at the bottom of your financial structure, when you're building your financial home, the first thing you want is certainty when it comes to income, certainty when it comes to cash flow, because no matter what happens over here with life insurance, whatever you decide to put your money into are fancy words such as asset allocation, diversification of your financial strategies. No matter how